All right, on today's 212 Startup Series, we have Eric Cox of Netcapital. Howdy, Eric. You want to give us a little feedback on what Netcapital does?
Absolutely, absolutely. So thank you so much, Dustin, for having me. Rajesh, always a pleasure to see you as well. Netcapital is a registered funding portal. We're headquartered in Boston. We work with startups across the United States, though, and we allow investors from across the world to find and fund innovative technology companies, mostly technology companies, but all sorts of innovative companies.
Nice. So, would you consider yourself a Reg CF platform?
That's exactly right. So we're spun out of the Jobs Act. The last 5 years, there's been some pretty transformational changes in the private capital markets, and we're one of the entrants that leveraged Reg CF, Title III of the Jobs Act, to allow entrepreneurs to raise capital online, and for non-accredited investors and accredited investors to get in this really cool asset class that is early stage companies.
Nice. I know that you have some wrinkles to the way that you look at crowdfunding. How do you think about how you compare to some of the other crowdfunding platforms, or what's sort of your special sauce?
Yeah, no, that's great. So first off, I love all of the other players in the space. I think we're all going in the same direction. We're all starting to coordinate a little bit better and just support the ecosystem. So there's a bunch of great players. Check them all out. We're definitely a top five platform in terms of most metrics that matter: transaction volume, issuers, percentage of acceptance rate, success rate. We really view ourselves as the opportunity platform. So we don't have any minimum revenue requirements. We don't make you find a lead investor first. It's all about coming to us, working with us, very personalized. And if we can sit down and make a plan to get to your fundraising goals, then likely we can work together and get you on the platform and start raising capital. So we really want to be incredibly democratic. Democratic access to capital is our ethos. And so really trying to minimize the barrier to entry for these entrepreneurs and minimize the barrier to entry for investors as well. So for those who don't view themselves as investors, you too can invest in early stage startups. This asset class is incredibly risky, so you should make sure that you only invest what you're comfortable potentially losing. And nothing I say is legal, tax, financial advice, or otherwise, but we think it's a pretty cool opportunity to be able to get in these early stage deals as little as $100 most times, and you can invest with a debit card, credit card, ACH, or wire transfer, and we take care of the rest.
That was one of the things that really I noticed talking to a lot of the various, Rajesh and I work with a lot of different crowdfunding platforms. And, you and I have known each other for quite a while, actually. We both have that Michigan background. So right
Go
when,
blue.
we were getting, go blue, absolutely. Right when we were getting it started, I remember, it was random, one of those like fortuitous LinkedIn connections that actually like blossoms into real friendship. But, kind of seeing your progress and net capital progress over time, what really struck me about it that was so different is just like your approach is much more, hands-on versus kind of like programmatic. The weird thing is at 212, we do the opposite. Like a lot of the cap table players are much more like hands-on, and we are more like software enabled, scalable. It's easy for me to, I kind of like, it jumps out at me when somebody in kind of this like modern sort of SaaS age is like really sort of like getting in there and like, getting into the sausage being made. Why did you make that decision? Why do you take such care with the people that you work with?
I love that question, Dustin. And I think ultimately it was out of necessity. We're a tech company. We love technology. We try to streamline the process as much as we can, but investing is an incredibly relational experience. There's a lot of sentiment involved, even though we all want to pretend to be the most rational version of ourselves, but there's a lot of emotion involved. People like to meet the founders. People like to really kind of touch the product if there's a product. And investors like to really kind of understand the company. And what we learned was allowing people to self-service their way onto platforms was not serving all companies well. And so, from the very beginning, we worked together and built a custom fundraising strategy. How are you going to get to the first 10,000, 100,000, sell out the $1 million round? Who's in your ecosystem? What does your network look like? Friends, family, community groups, alumni associations, obviously. And we help people work that out so that we don't just hope for the best when we show up on the platform, which generally speaking, I don't think is the best way to go about fundraising. It takes a ton of work online and offline to raise capital. And so we think having some folks there every step of the way, guiding you through the process, answering your questions, it takes more manpower. We have over 40 people on our team now. Not as streamlined as some folks would like tech companies to be, but we think that's part of why we have success in fundraising is that we make sure that the offering page is investor ready before investors see it, and we work through your narrative, and we coach these entrepreneurs and guide them through the process, and our whole model is based off of success. So they raise more capital, we make more money, so helping them be successful is critical.
Yeah, and
Can you
we
talk about
recently
your?
had BNN Nano come on our podcast, and they are one of your customers, and he was super happy with the whatever he got out of Netcapital. So he said it was like a no-brainer. Just showed up, he raised $1 million and started building his business. So that's pretty cool, actually. So what is your engagement like? Tell us more about what you do at Netcapital, and what should a founder think about before they approach Netcapital.
Absolutely. So I love the BN Nano story. Steve, I count as a friend now. We actually met through Pepperdine, my undergrad. Pepperdine's most fundable companies. They do an incredibly thorough screening process of thousands of companies every year, and they bring a handful out to Malibu and do a really cool event. And so if there's any entrepreneurs hearing this, you should definitely check out Pepperdine Most Fundable Companies. Apply. At the very least, I think you'll become a better company for it, regardless of if you win any awards. But yeah, BNN was a platinum award winner, so one of the top three out of thousands. So they were already a phenomenal company before we got to them. I encouraged him to come onto the platform, and he's like the model issuer. He works very hard. He engaged with the Q&A. He didn't run any digital marketing. He just went out there and talked to people and told the good story about what he was building, and it was compelling. Material science that you can add and change the properties of other materials, incredible. And I'm really excited that they were able to sell out their $1 million round, and continue to grow their company. So it was great working with them, and I hope to continue to work with them in the future. Me myself, how I got to Netcapital. Yep, I born and raised here in LA and Orange County. I call it the Southland. I don't think we don't have to separate ourselves. So I grew up in the Southland. Went to Pepperdine undergrad. Fell in love with entrepreneurship through their microfinance program. So we would sell water at like sporting events from Costco, raise a little bit of money, and then anybody who went to the Buenos Aires study abroad program the next year, we took that money and deployed it into a little leatherworking community called Adulam, outside of the main city of Buenos Aires. And it was amazing. We took like $6,000 over there, not a ton of money, helped them buy a little machine, and they returned the capital before we left,
Mm.
and they're off to the races. They're just fundamentally better from then. And ever since then, I just embraced what my theme of life I call positive cyclical change. So I love the one-off experience of helping somebody, but that's positive, that's cyclical, that's generational, and that's the change I think that's really most impactful. But in that experience, there were so many legalities, and there was so much difficulty of being able to lend this tiny amount of money. Had to register in all sorts of states and deal with attorneys from all over, and that's when I was like, I think I want to better understand that part of the process. So I applied to law school, ended up at the University of Michigan for law school. That's why I'm a big Michigan fan. And ever since I was there, it was all entrepreneurship, all venture capital. So I did the entrepreneurship clinic, and I stayed on as an advanced student attorney there for a full year. And so we gave free legal services to the community, Detroit and the surrounding areas. Phenomenal experience. I met some great entrepreneurs there. I actually did the trademark and some other legal work for Morning Brew, the newsletter. Phenomenal group out of the University of Michigan. Love Austin Reef and those guys. And I learned a ton. And then I did the social venture fund, which was a student-led venture fund where we were investing University of Michigan capital into startups. Like, come
Mm.
on, like that's the coolest thing in the world. It was the only top 10 law school doing it at the time, and I learned so much. And then also did venture capital. I became a venture capital fellow and worked at two other venture funds while I was in Michigan. One regional, Invest Detroit, and then one national and Mercury Fund. So I always loved the capital provider side, but I wasn't sure if I wanted to be a VC. I still felt like an entrepreneur in my core, but I knew I needed to check the box and go practice law. And fortunately, Cooley brought me back home to California, and I practiced in their headquarters in Palo Alto. Uh, and I had a blast. I was on the emerging companies, venture capital, M&A, and capital markets team. That's what makes up the big corporate group there. So my two claims to fame were I was on the team that did the post IPO cleanup for Snapchat, now Snap Inc. That was unbelievable experience. My mentor Eric Jensen was the first lawyer to really do that type of fundraise where there was zero voting rights associated with those shares. We weren't even
Mm.
sure if you could do that. Revolutionary. And then I was also on the Apple team that bought Shazam for a reported $400 million. although the total amount was undisclosed. And that was awesome. I know more about Shazam than basically anybody in the world, I feel like, because they were the target company. And then one of my best friends from law school, Rob Burnett, he went straight from Michigan to Techstars, the large accelerator network. And while he was at Techstars, he met up with a scrappy startup called Netcapital. And he learned about what they were building and really enjoyed it and left Techstars to join Netcapital very early. I think it was employee number 7. And they were growing for a couple of months. And he was telling me, hey, they want to expand from Boston to the West Coast. And I think you're a good fit. And it was an opportunity to put my entrepreneur hat back on. It was an opportunity to come back to the Southland. And it allowed me to check a lot of boxes. We're a member of FINRA, regulated by the SEC, so we still play lawyer a little bit. We are heavily regulated, but also we are definitely entrepreneurs. There were 9 of us when I joined. There's a little over 40, as I mentioned now, so very much in growth stage entrepreneurship. And we're helping entrepreneurs get capital, so felt a little bit like venture and building out the decks in a venture thoughtful way. Very much felt like I was still playing VC too. So I couldn't have imagined being in this position. I do feel like this is my absolute dream job. And now I'm the head of growth at Netcapital and just trying to continue to build out this network and build out these relationships and help really, really cool companies raise capital online.
It's not every day we get to have another Michigan alum on the show, so I'll take a moment to just dive into that ecosystem real quick, a little side quest, because I was a Michigan alum as well, and I was on the Frankel Fund, and so that was a pre-seed venture capital fund where we invested, did due diligence for all year, and then wrote like $100,000 check into a company. So I got to see from the inside, just like you, kind of like what a vibrant ecosystem that Ann Arbor and Detroit startup scene is. Have you been keeping up with it? Do you know how are things going there these days?
I do. I do keep track of them. I try to do the best I can. I need to get out there again soon. Obviously, the pandemic didn't help, but Michigan will always have a special place in my heart. It also has a special place in Netcapital's heart. Not a lot of people know this, but one of our early successes was a Michigan startup that I worked at while I was a law student. And so there's this cool little company called Court Innovations at the time, and all we were really doing was building out some software to allow people to pay parking tickets online. Super straightforward, but it was solving a pretty serious problem. People would get a parking ticket, be unable to pay, get their license suspended, drive to work because you still need money, get a driving with a suspended license ticket, and then a bench warrant for your arrest. Basically debtor's prison, right? Just all because you couldn't afford to pay. And there's a huge distrust in certain communities with court systems. So the idea of showing up to the court, can you even talk to them about setting up a payment plan? What does that look like? If I show up, am I going to get arrested? And so just really kind of minimizing that friction and allowing people to do that online was really compelling to me. And me and a couple other folks worked at the fund. It was led by one of our phenomenal professors, J.J. Prescott, who's my criminal law professor. He's a brilliant man. And a handful of others. MJ Cartwright, she's amazing as well. She's the CEO. All that to be said, that was one of our early fundraisers, $500,000, a little more than $500,000, way back in the day when Reg CF was not heard of at all, and it really helped us to get to where we needed to be. And it was really funny that it was one of my employers slash Michigan company that really helped Netcapital get that first win on the belt that really helped us continue to grow into the industry. But I do still keep track of the folks. We have a couple more Michigan companies that have come through. We have a couple more that are in the pipeline. And I think you're right. One of the things that's really hard about the Michigan ecosystem is, although there are some capital providers for the first million, let's say, there's not a whole bunch of venture capital funds that can handle the next check. And unfortunately, even if because of that factor, folks are more likely to just defect to the coasts because you want to plan ahead. I mean, if you could take $1 million from somebody who also has the 5 ready and the 10 ready and the 25 ready, that's a really compelling narrative for entrepreneurs. And so a lot of early stage investors in Detroit and the surrounding area were missing out on deals because they didn't have massive funds behind them ready to put capital in the next round. And so hopefully what we were hoped was, we could work together on those earlier rounds, first million, first 5 million, up to 75 million through Reg A. And we can really kind of help syndicate these deals in regions that matter. And we've worked with companies like I think it was over 25 states at this point. Don't quote me on that. But we really do believe in the whole rest of the world. Despite being a Californian in my core, we do really believe in helping entrepreneurs across the United States raise capital. It's critical.
Dude, this is fascinating. I think keep talking, Eric, keep talking.
What do I?
We,
You don't have to tell me twice. I love to hear myself talk. No, I'm kidding.
I remember thinking about like at school in Michigan and kind of seeing how they were trying to like fill in all the gaps from like 25K to a million. It was like you would get some grant for 10K and there'd be some like 50K opportunity, and the Frankel Fund comes in or out, the Zell Lurie fund comes in for 100. But you're right, like not having that, like you got to like fill in the whole curve. And yeah, it does make sense that Netcapital and crowdfunding could be really useful. I mean, if you can't finance your business on an extra 1 to 5 million a year, I mean, maybe you need a better business, right? Like, there definitely
I,
are like,
I love that, Dustin. I love that.
yeah,
And I should mention actually one last piece about Cord Innovations, now rebranded as Matterhorn. They were also one of our first exits. They were actually acquired and returned a multiple to our investors, to our
oh,
net capital
nice.
investors. So we're really, really proud of them on
How
that.
many rounds of
Again,
funding did they need before they exited?
yeah, so they raised with us. They raised offsite a couple million. Again, don't quote me on these exact details, but raised offsite for a couple million, and then within 3 or 4 years, they were acquired. So and
So,
oh my goodness, I have one last piece I have to share.
okay.
The power of crowdfunding right here. And a lot of people don't love that phrase. I don't either, but the private capital markets is kind of long. So let's just call it the power of the crowd. There was $100 investor, a truck driver who would drive across the United States, of course. And if you got a ticket in, let's say, rural Kentucky, you had to go back and deal with that in rural Kentucky. And so he saw it immediately. And he was a $99 investor, minimum investor, right around $100, the way we like to keep it democratic. But he actually was so inspired by this model that he actually helped Court Innovations get into court systems along his route because he just believed in it. He just believed in it so much, and he was telling people about it and working with them to get into these courts. I think they got into 4 courts with his help, and I just think that's really powerful because we all think I hear so often, and I get it, but I hear it probably more than I should. I really just want to get a handful of like 1 or 2 checks from sophisticated investors. I want to get smart money, which I think is incredibly offensive. But these folks can be really valuable in a way that most venture capitalists are just unable or unwilling to do.
Yep.
And I think that's an important piece of the crowd and why I think it's taking off the way it is.
Yeah, I think it's great when you have a customer and investor and an influencer, everything bundled into the same package. That's the best of all worlds.
That's the dream, and I do honestly believe, and again, I've drank the Kool-Aid pretty hard. I've been here for almost 4 years now, but I do believe we might get to a point where people just are unwilling to use products that they don't have a chance to own a tiny piece of. Like,
Mm.
why would I use product A when I own a piece of product B? And then on the other side, if you have a company that's not super moated, that doesn't have a really big barrier to entry, as soon as you prove your success, the competitors are there, ready to come. The knockoffs are coming. And
Yep.
so having a little bit of stickiness, a tiny equity piece in a company, why would I go to the cheap knockoff? Every time I buy your product, I benefit my investment. So I think there's going to be I think, as this continues to grow, I could see some really interesting things happen from consumer spending habits.
Where do you think
Interesting.
the growth of the crowdfunding industry is going to show up most? Do you think that's like number of issuers, like dollars raised, and how do you think of like is it like certain regions or how are you forecasting growth in the capital?
Love it, love it, love it. And again, I do always mention, so Netcapital is a publicly traded company. We are on the OTCQX, and we just filed our S1 to uplist to the NASDAQ. So everything I have to say, I have to be really thoughtful about. You can go find NCPL on your brokerage account. And then obviously, this is not an investment recommendation, but you can learn a lot more from the public filings if you go check that out. But as like, where do I think growth is coming? I think it's going to be very interesting. I think the March update changed a lot. The March update, for those who are unfamiliar, increased the maximum that you can raise through Reg CF from 1,070,000 all the way up to 5 million. And not to say that $1 million isn't a lot of money. $1 million is a lot of money, but $5 million is Series A. $5 million is a different amount of money. I think what you're starting to see is really sought after companies that have built out. If you can create a product and get customers excited and engaged, you can go to those customers and get much better terms. And remember, I come from venture. I love my VC buddies. I do not think we're mutually exclusive. I think we're just a part of the ecosystem. But I think you're going to see people decide to take. Our investors get no board seats, no pro rata rights, no liquidation preferences, no control terms really. And so I think
Hmm.
if you built a company well and have people that love your company, I think you're going to see really compelling, exciting companies that venture capitalists want to get into. And you've already seen this, deals that have been highly sought after showing up on platforms and selling out their 5 million that way instead, and honestly might be better off for it. I have one of my buddies that I advise. He has a startup here and it came out of UCI, created the company, grew the company, took that first round. He was super excited, backed by Coastal Ventures. He was a YC company, living the dream. And then when they were preparing for that Series B, they brought in the new CEO that they thought better reflected their
Ah,
ability to raise capital. And he's like, "No, it's okay. I'm still the chief strategic officer. I'm still happy." And he's no longer with the company anymore. And I'm not saying that's
mm,
representative, and I'm not saying there's any ill will there. But things happen when other people put their money in and have a lot more control over where
Yep.
the company goes than you did before. And I think people are becoming more aware of that.
So you said something very interesting that you said the investors don't have pro rata liquidation preferences. Can you quantify that a little bit more? Is it because the terms they sign are those, or
Yeah, and so I should
okay?
speak. Yeah. So I should say, I should clarify. I'm only talking about Netcapital here.
Yep.
Netcapital only sells common stock and membership units, so corporations or LLCs, but it's pure ownership. It's basically what the founders have.
Ah,
And so with those terms, basically, I'm giving you some money. It models a little bit more like the public capital markets. When I buy Apple shares, I don't get to call Tim Cook and say, "Hey, when's the iPhone 16 dropping?" You know what I
yeah, yeah,
mean?
yeah.
You basically invest and you hope that they do what they do best, which is grow the company and create value for the shareholders. But venture gets a little interesting where they give you the money, but then they also demand to be able to maintain that
Sure.
percentage ownership. And if you sell, they get premium returns. And if you want to do certain things, you have to get their permission. If you want to spend a certain amount, you might not be able to
Mm,
go in that direction. You want to open a new division or create a new product, you're probably going to have to get the green light from those folks. And so it's
sure.
just different on how much control you have over growing your company. And our investors, again, a lot of them accredited, a lot of them non-accredited. But either way, we bundle them all together into one line on your cap table to make it easier for follow-on financing and everything like that.
Hmm.
But also, realistically, the goal is it should be like you're hopping on TD Ameritrade or Fidelity or whatever and buying shares. You're hoping that they grow, you hope they get acquired, you hope they go public, but you don't necessarily get to determine the future of that company. And our investors are comfortable with that.
I was just
Interesting.
talking to a buddy of mine, another entrepreneur, and he's just kicking off this new project, and he's thinking about, how to finance it. And someone gave him the advice, like, "Oh, this is a big idea. You should go raise like $100 million for this." It's crypto, of course, right? They just throw on stupid money and whatever. And I'm like, "All right, let's like walk through this. Like, what are you gonna do with $100 million? First of all, like, how are you like? I was like, if you raise a bunch of money, like you stop doing as the founder and you just start managing, right? All you can do all day is like hire and manage and build this like massive bureaucracy. And let's remember, you're just starting the company, so like you can't have product to market fit yet. Like you cannot have. And so now you get like super big and bloated. And now like if you want to like pivot, you're talking about like killing off like an entire like division of like 30 people. Those 30 people probably have some stickiness in your company. And like, so like the way Rajesh and I did it. So, I mean, obviously it's an extreme case. But even if like for like, I think some people, even, founders that have had success before and it's a hot market, like there's opportunities. I'm seeing people that are like, you're getting $5-10 million checks, with some napkins. And it just seems like to me, it's like, it's fairly dangerous. Like in addition to all the control issues, if someone writes you a big check, they are going to have a magnifying glass over everything you do. And so, it just creates a lot of risk. And also, the way Rajesh and I built 212 was we really optimized for control. We said like, okay, you're going to like do things to raise money from people that aren't trying to sit on our board, are giving us like reasonable terms, and so we optimized for control at like a really small like Delta Force team, and went and with $1 million, and 5 or 6 people went and built a product that took Carta, 1,000 people, 700 people, and like $700 million. And now like and throughout that time, like because we were so small, we were able to be like really nimble And now, like one of the options on the table for us is like now that we have a community and like we're really nimble early, now we can go to the crowd and like raise from our customers. And so it's like find angels, like piece it together, like make it happen until you get like product market fit and you get a network and customers, and then like go to the crowd and raise from your customers, and like boom, like all of a sudden you like totally reduce dilution, you maximize control, you have like control of your own destiny. It's a little bit more painful because everybody wants that big check and they don't want to live paycheck to paycheck like chasing down angels for 25K checks to like keep payroll going and things like that. But like it's definitely a path that is like working for us. And at the tail end, the key is like now the insight is like if you can get customers, then you can get capital.
I love that. If you can get customers and you can get capital, somebody put that down. Clip it, chat. Clip it. No, I think that's right, and I think that's a very thoughtful way. And you're right, that can be a little bit slower, and it could feel different than just taking massive funding and then hoping that you don't go for a down round. Down
Yep.
round's a
Oh yeah,
problem.
more risk. Yeah.
But yeah, but also I think one of the things I love that we're seeing now too is angel investors are getting more comfortable with our model, and they're basically syndicating the deal with us. And so that $1 million check that you took, we can have that go straight to the platform, and you can have a $5 million max, and you're already a million of the way there. I mean, how compelling is that story? Join alongside this angel, $1 million already in the deal, and I think there's real opportunity for that as well. And you can kind of have your cake and eat it too. You can release the funds. We built out a rolling close in our technology, so you can actually access the capital as it comes in. So you can release the funds from escrow and continue to raise, and the website will reflect the total amount raised still, so you get all that good traction still. So there's a lot of cool things to be done with angels being more comfortable with the market as it grows. We're celebrating year 5 now. We are still, this is nascent. This is we're still in the educational phase, right? We're just still letting people know that you can do this. 5 years ago, we're at Cooley, we're telling folks no non-accredited money. I actually went during doing diligence for the social venture fund, had to kill a deal because a non-accredited investor slipped in and tainted the entire capital pool. And when non-accredited investors get in not through a platform, they get a rescission right. Every single investor can ask for their money back. And of course, they don't ask while things are going well. They wait till things are going poorly, and then it's like, hey, actually, there's a non-accredited investor. I'd like my money back, and that can be a real problem. So this has solved a lot of issues. I think you're totally right. It's changed the framework for sure. And I think it's good for entrepreneurs to start thinking about what is right for you. And that's one of the things actually I love about 212. We've sent companies your way. I love being and working with you. You guys saved them a ton of money on their car insurance by switching to Geico. No, I'm kidding. And so, one of the things I love is your analytics, the waterfall assessment, the analysis that you can do. You can be thoughtful. Like what is raising another $1 million at this price point look like for me from a capital ownership standpoint and an equity preservation model?
Yep.
These are the types of things that entrepreneurs need to know. Ultimately, what decision you make is up to you, but as long as it's informed, I'm fine with it, and you help them make informed decisions. So
Yeah, and just today I was helping a founder. He had previously raised on a convertible note and a safe, and he was getting advice from his lawyer. Interestingly, saying that okay, go raise at a 15 million pre, raise $5 million. Your post is 20. And it makes sense if you didn't have any
conversion
other
mechanics.
note or safe behind the scenes. So this founder kept telling all his potential investors, hey, I'm raising 5 million or 15 million pre, and the investors you were talking to assumed it is a 20 million post, and they were doing all the math. And so he's actually far down the lane. And today is when he came to me and said, hey, I need to model this out. And so he became a customer. And I said, dude, no, that's not, your numbers don't work like that. So you have to reduce your pre-money valuation if the investor is expecting a 20 million post. So these are all the problems that, I mean, it's unfortunate the founders don't pay attention to the equity all the time. They're busy building the business, and they depend on some bad spreadsheet model, and bad things happen very quickly. So um, totally, you're absolutely right about that. So one question for you then is, what kind of founders are attracted to Netcapital? Like, is there a profile for a startup or a founder that would be a great fit for Netcapital?
Yeah, so I'm gonna twist it a little bit if that's okay. So what type of founders work best for that we love to find the ones that we're looking for. For me, so I love it. I still roll up my sleeves and review the pitch decks. I still give probably more feedback for free than I probably should. I still love it. I'm still an entrepreneur's entrepreneur, but I just love hungry. I love Scrappy. I love Steve from Being Nanos. There was nothing there. It didn't honestly. I'm grateful Steve came to Netcapital. Steve would have raised $1 million on any platform.
Yep.
No one was stopping Steve. And so he was hungry. He was scrappy. He was willing to do what it takes, and that's pretty much the first thing I look for. Because again, no matter how easy we make this, no matter how virtual and digital we make it, digital stock certificates, debit card investments, minimum $100, like we've made it a lot easier. Fundraising is still so hard. It's gonna be hard. You have to work at it. There's no getting around that. You're trying to convince somebody else who has money that they should give it to you in exchange for something that is very theoretical, mostly, right? I mean, and
And you're competing
so
with all the other things that they're trying to give money to, or
and you're
you
competing
know
with
evaluating. The opportunity cost is crazy
yeah,
right now.
yeah, the opportunity cost is crazy, and the hardest part too is like, we joked around in Silicon Valley. We say every investor wants to be first to be second, and that's still so true. Like, the first check is so hard, and it's so and getting that money helps it makes it a lot easier later. But you're not only competing with the other person who needs $1 million, but you're competing with that million going into a $20 million pool on a company that's already proven to be successful. And data analytics and quantitative analysis has basically told venture capitalists, forget the early stage stuff, just make it up on the back end. And so later stage is becoming more and more common, and we're happy to fill that role. We love that. We have companies that come to us only need $50,000. I love that. Take 50, do something with it. Let's come back. King's Crowd came through Netcapital, did their first 100,000 with us, and then sold out their $1 million round with us later.
Yeah.
And we love that model. And I think it was equity preservation. They increased their valuation. They proved that the 100,000 was worth doing with proved product market fit, like you said, Dustin. And so if you want to come and just do a little bit of money to help you get to the next stage, we're comfortable with that. Not a lot of platforms are, because it still takes a ton of work. It's kind of like the Cooley model. Cooley
Yeah.
represents early stage companies so that you become massive companies and stay with them for the IPO, right? Like we rep, that's kind of how that works. You lose money on the early stage stuff sometimes, but when they come back for you for bigger, better things, then you hopefully make it up. And we're happy to do those early stage rounds too. I think I lost track of it. But sorry, Scrappy is the first thing I look for entrepreneurs. Relatable and understandable is something. We do some pretty complicated stuff. Like, we've raised capital for pharmaceutical companies. A lot of platforms don't want to do that. Like, long sales cycles. If you don't get to clinical trials, second clinical trials, it's over. It takes a lot of money. It takes a lot of time. A lot of folks don't like that. But we've been able to do multiple $1 million+ raises for pharmaceutical companies, material science companies, another thing, being nano like that. People don't tend to love that. It takes more time, takes more money. But so we're industry agnostic. We're comfortable taking those moonshots. We're comfortable working with companies that are harder to do with. As long as you're coachable, we've done over 200 of these. It helps a lot if you kind of follow our lead a little bit. So coachable, relatable concepts are great. And then of course, if you already have a user base, you're partially there. If your users really love your stuff and you can keep the price point low enough to come in to invest, then they tend to. So
That's awesome that you're such great coaches, though, because everybody needs a coach, and founders, you've done this so many times, and most founders, this is their first go. They're not only they're struggling to build a team and figure out product market fit, and it's just like so much dark magic around raising capital that it's great to have a Sherpa like Netcapital and yourself, just like guiding them through that. And so, kind of again going back to how nice it is that you're doing that heavy lifting. What is your business model? Is that something that you can share? Is
yes.
it constant or is it variable?
Nope. I can share that. Thanks. Good question. So I love that question because I have a great answer. We are the value provider in the space. We only take 4.9% of the total amount raised. So that's different than the 7.5s and 10% out there that you see. A lot of other platforms take equity. At this point, we do not. So another 2% of securities sold you get to hold on to. So that's another piece. We do have a one-time upfront fee. That part I won't disclose because it's that one. Not super flexible, but a little bit more variable. Like, we have a lot of partnerships, and partnerships can help change that upfront fee, and we can get creative about it.
It wasn't
But
crazy though, I won't say, because I know we've talked about it. It's not like a showstopper.
Thank you. Yeah, no, I think it's quite manageable, especially when you consider the fact that we acquired a law firm and brought it in house. So we actually do all the regulatory filings for you and compliance work. We also build the offering page with our own developers, so you don't need to use your engineering resources to build the offering page. And then of course the fundraising plan and the fundraising strategy, which I think people always underestimate, but almost might be the most important part of it. that's also included as well. And so if you go to Cooley, our first years when I was there were 500 an hour. And so you always have a partner, you always have a junior associate at least. And there might even be a senior associate in there somewhere. I don't think you're walking out preparing for a fundraise for less than 5 figures.
Yep.
And our upfront fee is definitely less than 5 figures. So
Nice. Yeah, a lot of, I mean, you just, if you're a startup, like you gotta be careful about wasting money on lawyers. Like it's just like the easiest thing to do to think you have to do it. You just have to be a little smarter, like, in addition to platforms like obviously, that's like one of our big value props is like, let's build products that do things that $400 an hour lawyers do and let the lawyers do the more interesting things. And you'd be shocked that actually the lawyers love it because they don't want to do the like stuff, this like, base level stuff that can be programmed and automated. So yeah, love the cost savings angle there as well. Rajesh, it looked like you had a question.
So yeah, Eric, you were talking about being one line on the cap table. Can you tell us more about that? Is like through a custodian account or SPV? What are you doing there?
great question. Yeah, and we did this from the very beginning too, by the way. So this was one of the things that helped me come over. There were a couple of factors. I was like, I don't know. I like my cushy big law job. I just got married. I don't know if I can do this. But first, let's talk about the specifics. And I was like, I've seen enough cap tables to where if you're letting other platforms were letting every investor show up on your cap table for so long, and I just don't understand how that was ever going to work for follow-on investment. Like if you show me a cap table and I have to scroll through the Excel file, I think most VCs I know would just get rid of it. I just don't think it's just too much of a headache potentially. And so
Mm.
from the very beginning we used a custodian. That's right. And you can use SPVs now as part of the updates in the regs, but we have such a great infrastructure built out already with the custodian. The custodian is the single line. They're the holder of record. Every investor is a beneficial owner, so they actually do own those securities, but they're just held by the custodian. And it's a super streamlined model to allow us that if you raise from one investor or 1,000 investors, which keep in mind is not uncommon, $1,000 from 1,000 investors, that's a that's a pretty consistent way to get to $1 million.
Mhm.
So you can see 1,000, and I think you want to. I'd love to have 1,000 evangelists, 1,000 foot soldiers out there supporting my business and telling their
Yep.
friends about it. I like that. And so yeah, so custodian from the very beginning, one line on the cap table. It allows us to do some fun things as well, but that some of those things I can't quite disclose yet. But I think yeah, so custodian account is the way that we do it,
So
and then
was there any updates on the March 15 that something about custodian not technically being one line of the cap table? What is that? What can you tell us more about that?
yeah, so that's a little bit complicated, and I don't want to get dig too much, but essentially they outlined what an SPV would look like for a fundraise. You still don't see a ton of it because it's still SPVs are great, and you see them all the time in the private capital markets, Reg D
Hmm.
offerings especially. Um, but uh, and I think we're going to see some other platforms start to do some of that stuff. But the custodian model is so straightforward because of that beneficial owner, beneficial, and then holder of record model. It's very well known in public capital markets, and that's basically what it boils down to is a single entity that holds it. They are the decision maker. They have an unconditional proxy to vote those shares. So that these are voting shares, but the vote is held by the custodian. So it's just it's honestly a little bit of legal fiction. I don't like this. I don't know. I should probably start thinking about the way I say things. But like, I mean, like, what is the? It's a holder of record.
Yeah. So is it like an LLC that gets created for the custodian, or is it like a phantom instance?
Right, that's a great question. No, they were actually the transfer agent. So it's not a that's the difference between an SPV. SPV would be a
Mhm.
separate entity owned by different individuals or other entities. This is
Yep.
really just one individual transfer agent that holds and manages those shares on behalf of the beneficial owners. Great question. So every single time you'll see, I can't even remember the name. We switched custodians recently. I'm sorry, I'm not gonna have enough time to find it. But
Also, it's
it
much
used to
more.
say
In summary, it's much more direct than an SPV. In an
correct.
SPV, there's a legal entity that's like sits between your ownership and the company ownership. With custodian, you own it. It's just someone else is managing that for you.
Yep, that's a great way to think about it. Yep.
That's very cool. Yeah.
Interesting. And then have you heard? So let's say I'm an investor. I'm writing $100 to, let's say, 50 companies. Now, I as an investor, how do I see how each of my 50 investments are performing? Like, so, are you do you get involved in any of that aspect of that?
We do. That's a great question. So the first part is that the Netcapital dashboard, you log into your netcapital.com account and you'll see all of your investments, how much you invested, how many shares you own, at what price you purchased those shares. And I say shares a lot, but really it could be stock or membership units. Remember, we can sell ownership in
LLCs.
LLCs. Yeah.
Yep.
But it's just kind of a proxy, it's like a shortcut. So you can see all of your ownership right there in your dashboard. Really kind of really straightforward. And then engaging with the customers. We have our own internal relations team, internal investor relations team. I'm sorry, let me slow down a second. We have our own internal investor relations team. So if there's any updates that you want to send, I imagine you guys probably send at least quarterly updates to your investors. Maybe monthly, but most likely quarterly. You would just send that to Netcapital. Our investor relations teams disseminates that to every investor that invested through the Netcapital platform. And so
Mm-hmm.
that's kind of the way. And then if they want to engage with you further, we also are that trapdoor there. So $100 investment doesn't get to call you on your cell phone. That would not be good. But we have people ready to field those questions, and we can batch them if they're all similar questions, so that you kind of doesn't feel overwhelming. And then if anything comes up, we then reach out to our issuers and tell them, hey, an investor said this. Perfect example, actually, we were doing a live Q&A for a company that was actively raising on Netcapital. And some investor, I guess, what happened to be on our network was a former investor in Blaze Pizza, cut a $25,000 check on that call. And so I watch it come into my Slack channel. I'm like, that's cool. Not representative, but still can happen. So we reached out. I said, hey, issuer, would you like us to check to see if that's not insignificant, not massive. We see 6, 7, even 8-figure investments before, but let's see if they want to get more involved. They might have some input to help you grow. And the investor was like, no thanks. and that's it. Like we're not going to twist their hands. Like we checked. If that investor would have said yes, then we would have match made and see if they could do great things. But they wanted to be a passive investor, and so it's pretty much opt in on that relationship. But our investor relations team handles the whole thing.
And what
So
about
it's
post?
super. Sorry, good man. Good.
Oh yeah, what about post? Could you talk a little about the secondary liquidity that you provide? And that's pretty unique.
Yeah. So the STF, the secondary transfer feature, I can't dig too much into the details about that, but I can share that we actually engaged with an ATS, which I think is an alternative trading system. I think that's that
Correct.
acronym, right?
Correct.
Okay. So we formalized the relationship with an ATS to allow, part of the reason why we only sold common stock and membership units from the very beginning was to be able to allow people to trade those shares. Like liquidity is one of the biggest issues in the private capital markets. And if you don't believe me, ask any investor. That's
And you
actually
need
how they justify all the crazy terms. That's how they justify it. They're like, well, I have to have all these crazy terms because I can't sell it if I want to. And so like, well, why don't we just allow you to sell it? And then don't do all the silly stuff. But anyways,
Yeah,
we
that's
built
because
up.
if you're a VC and it's illiquid, right? Just to give the audience some context, like
Yeah.
I'm writing you a check and I'm locked in for 5 or 10 years, let's say. And so what the VCs try to avoid is a situation where like founders, like they get to a point where it's a lifestyle business and they just start sucking money out of the company. They just start like paying themselves huge salaries and they're not growing, and so there's no like exit equity value being built. And so if in those kinds of scenarios, VCs want to say like, look, I'm illiquid, I can't go anywhere. I want to be able to have control to like dictate strategy or dictate your pay or to replace you or whatever it is. So like liquidity does solve a lot of these like complexities that manifest as a result of it. And also now I'm starting to click in your model because with secondary liquidity you have to trade apples to apples, like with like preferred stock, like everything's different. And so like there's no, if you have someone buys in a 15 million pre and a note and someone buys in a 30 million and post note, like you can't trade these two things. But if everyone has common the same units, then like it's fair game. So now I understand why the custodian model makes so much sense for you too.
And that's actually kind of the main reason. So the one line on the cap table and then the potential liquidity. And that potential liquidity, I was like, oh yeah, I need to be a part of this. Like that could fundamentally shift private capital markets, hopefully
So
forever,
all
in
that
the better.
liquidity happens within the TA, though, right? It's all within the TA. How
And that
much
goes
of?
back to and that goes back to why the custodian has to be there. Since the cap table only has one line,
Yeah.
whenever the shares exchange hands, the cap table never changes. And so the ability to be able to move those shares becomes a lot easier through a custodian. Yeah. Again, We're still
Yeah,
building this out. It's going to be a long haul. We're working with the SEC and everybody to make sure that everybody feels comfortable with this model. It's going to take quite a bit of time to really finalize this
I
piece,
see.
but we're working hard to build it out, and we think that's going to be important. We think that, and another way to think about it too is think about specific types of investors. So we did a phenomenal event with VaynerMedia, AJ and Gary Vaynerchuk, and they had some of their professional athletes on the line, and we were teaching them about startup investing. Keep in mind, the Golden State Warriors, their day job is basketball, but they're all just investors at this point, right? Like
Yep.
I think they're going to make way more money lifetime through their startup investments than they will from their professional capacity as ball players. But these folks know that they are one injury away from needing that 100,000 or $1 million back, right? And so being
Mm.
able to allow them to have liquidity is critically important, and that's part of why they partnered with that. Why we did the event with us and not another platform. Other folks like models, actresses, actors, they know they are, age is terrible in Hollywood in the way that people get treated, and that cash flow can slow up very, very quickly, and they understand that too. So there's a lot of folks that would love to take these types of massive risks. Remind you, we're talking about early stage securities, an incredibly risky asset class. Only invest with you're comfortable losing, but being able to have some transferability makes that less risky, just inherently.
Mm.
Can you talk a little bit more about your investors? I know some of the other. It seems like you do provide a lot of support, not only in the white glove and bringing like the offering, but also like leveraging your network to provide investment. It's you're not just putting it all on the founders, right? To go get capital and like raise from your network. That's one of the other big differentiators about Netcapital. Am I correct?
That's correct. That is correct. So we always like to say, think of us as an intermediary. You should come with the plan with some of your own money just lined up. And that's part of the fundraising strategy. Again, friends, family, alumni associations, community groups. There's so many ways to expand the pie. And you want to start off with people who are investing with just like they know you or your company, and that's why they're investing. And then you get a little bit larger on these concentric circles. That way, by the time you get to someone who's never even heard of you, you have so much money in the deal that the social proof is so strong that they just want to invest because they want to be alongside all the other smart people who made the decision to invest. And so it is strategic to be thoughtful, and a lot of that initial push, just to be quite frank, on any platform, a lot of that initial push is the founders. But we've built out infrastructure to support. So we have newsletters that go out at certain increments, like percentage raised and certain milestones. We engage with our investor base, tens of thousands of investors in our database that actively invest through the platform. And so we want to be thoughtful about how we engage with them. We don't desensitize our investors. If they hit unsubscribe, everybody loses. So we can't do every update, doesn't go to every person. So we got to be thoughtful. But we do. We engage with our investor base. Also, as part of the process, we work with accelerator networks and angel networks to do virtual. It used to be virtual roadshows. We're getting back to in-person roadshows this year.
Right.
Super grateful, God willing. So like in-person roadshows where they're comfortable investing through our platform, and so we teach them how to do that, and then you go and present to angel networks, and they can invest through the platform as well. So we do want to take a holistic approach, right? We love our institutional investors. Our largest investment was a $10 million wire transfer. Love that. But we also love our retail investors. $100 at a time, baby. Nothing wrong with that. And so how do we get all of these folks in between getting into the deal we're really thoughtful about? And I host a lot of our live Q&As. I hop on, I ask questions. We do some fun stuff, hopefully get investment. And then we have our internal public relations team that'll write a press release and shop it around to TechCrunch and Crunchbase, or maybe some industry-specific magazines. We worked with a company that's a space company, and they got Buzz Aldrin to tweet about it. Like that's pretty freaking cool, right? We're using our
Mm.
network as best we can to make super cool things like that happen. Because you can generally solicit it when you're on a platform. You can yell from the mountaintops, "I'm raising capital," in a compliant way that is not generally legal off-site, off of a platform. So helping them do those things is great, and it really starts with our investor base and our advisor base. So we've been very, very fortunate to have a strong advisory team and investor team led by John Fanning, the former CEO of Napster and chairman of Napster. He also was a first check into Uber and Facebook. Hopefully, if we have any modicum of success like those folks, then we'll all be just fine. And then a whole bunch of other players. Jason Robbins, the former CEO of DraftKings and former chairman of Sprint and Verizon, two different folks. Fidelity Investments, handful of folks, and they guide us, and that helps us guide others. So if you're a telecom company, it's very, very helpful for us to be able to go to our advisory board and talk about, talk to Ivan Seidenberg and Dan Hesse, Verizon and Sprint respectively, and see what are you seeing out there? What are your thoughts about this? There's no guarantees that any of these folks are either going to write a check or really move mountains for you. But we do have advisors that are very supportive, review a lot of our deals, and help us guide folks. So it's really top down from that. So I'm really grateful for our leadership internally, our CEO Jason, and the public company CEO Karine and Cecilia, CEO, CFO. So it's a really strong team, really strong advisors, and it helps us support the entrepreneurial ecosystem.
Well, fantastic, Eric. Appreciate you coming on, and appreciate all your successes. And yeah, going public was a big one. We didn't get to go too deep into that, but maybe next time we can double click into that more. A lot of growth ahead for Netcapital, and look forward to continuing to support each other. Thanks for coming on the 212 Startup Series.
Thanks so much for having me, Dustin. Great to see you, Rajesh.
Oh, likewise, Eric. Thank you.